Well, thanks everyone for joining tonight. I understand it is Valentine's Day and that makes it a little bit challenging for some people to join. So if you are watching this on record, I appreciate you for watching it on record. And if you have questions, obviously reach out as always. So tonight will be our second webinar on financial literacy, remembering that the Hatcher Way will cover two special topics every single month. And this month is about financial literacy and the second part of that. So tonight, I want to go through the financial disclaimer. So obviously, Hatcher Advisory and its subsidiaries, together with its owners, managers, employees, have endeavoured to ensure that this information is accurate. You must undertake your own research and seek advice from your financial advisors, brokers, and accountants to assert its application to your specific circumstances. So keeping in mind that this is general in nature, that your specific circumstances may differ from my examples here, and that is where you'll need some specific advice. Boring stuff is now over. Here comes the fun stuff. So tonight we're going to go through the perfect investment structure. So understanding where we want to, how we're going to structure our affairs, talking about how much money should we spend on lifestyle. All the time I get asked this question, and all the time I feel like, sometimes Heath was just talking before about, having some really big increases in his business revenue. And then I find that some people then will look at that and go, holy shit, I can buy a Ferrari, a red one. And because their business has increased its cash flow for that week, month, or year, their lifestyle changes. So thinking about how much we can spend on lifestyle, so we're going to cover off on that today, and then actually leveraging from the banks and seeing how we can, use the bank's money to really maximize our wealth creation, and or look at the different opportunities that we have in the market and what we can do there. Again, a couple of people have joined, so thanks for joining if you've joined a little bit late, but thanks for joining. So the perfect investment structure, and obviously closer to June, we're going to have a whole special topic on tax. I don't want to go into this with too much details, but we have trust, company, self-managed super fund, and individual. So 4 different ways that we can invest and structures to invest. And when we're thinking about those ones, we're trying to work out how much money am I going to make? How much money, how much do I want to pay on taxes? And what's the best structure to do so? So everyone who's got your camera on can play this game. Who here has a company? Just put up your hand. Yeah. And then who here has a trust? You can put up your other hand. Jenny put up a yellow hand. Nice, nice. I'm sure Jenny does have a trust, multiple trusts. Who here has a self-managed super fund? Put up your hand. Yeah. And everyone has an individual, so everyone has an individual. So they're really, there are 4 different mechanisms to do our investments under all the different structures we can have. So if we think about a company, and this is one of my pet hates when I deal with structures, and normally this is looking at things from other accountants. So hopefully nobody here has a company, owns a property under that company directly, and therefore wouldn't be benefiting from a capital gains discount. So when we're buying investment properties, when we're buying shares, any type of capital appreciating assets, we definitely do not want to do it under a straight company, because we're not going to get that discount. Investment properties are taxed at 30%. So they become really, really helpful there. And we use them we can use them with our trust distributions into a company and pay tax at 30%. Companies right now are paying tax at 25% if you are running a business. But the big problem that I always find with having a company is that the dividends have to be issued out to only the shareholders. So when we're thinking about this structure, mostly I always think about listed companies, those big, really big companies listed on the stock exchange. They're the ones that are going to always be that structure of a company. And if you aspire to run a business and be listed on the stock exchange, you'll probably be a company as well. But for investment side of things, it's not a friendly investment structure. And likewise, we wouldn't want to see too many people making the decisions to do investments under a straight company. Under a trust, however, there's some pictures of Scarlett and thinking about the future there, but under a trust, it allows us to make a decision today. Today, I buy a house. In 18 years' time, Scarlett will be 19, and we could sell a house in 18 years' time at a profit, distribute that profit to someone who is over the age of 18. And that allows us to make an informed decision every single month, every single year, of where we want that profit to go. So do we want it to go to person one? Do we want it to go to person one, say me? Do we want it to go to my wife, Jenny, say person two? Or say we go to Scarlett if she's over 18. And worst case scenario, we go to a company, and like I said before, we pay 30% tax. So the trust gives us that ability to pick and choose where we want the money to go, and we can buy property, shares, gold, silver, run businesses under trust. So we can do a lot of things under trust, which gives us the most flexibility. And again, as I said before, most of you would all have trust. Just looking around, yeah, I think most of you would all have trust in one way or another. So we have the self-managed super fund, and I bring this up because it's always an important conversation about our super. And last week we touched on what we're doing with our super. If we're wage earners, if we're putting money into super, what are we actually doing with it? And here's that option of actually doing the self-managed super fund. So in this case, we need to have a minimum combined balance of $200,000. But if we have a minimum combined balance of $200,000, we could do a self-managed super fund. And that has an effective tax rate of 0 to 15%. And you can still apply the CGT discount. And you have the ability to make your investment decisions. Buy property with lending, buy shares, buy gold, crypto, all that type of stuff. But you can't buy a holiday home and use it for personal use. But the problem with the self-managed super fund is if we start contributing additional money into it at an age of, say, my age, so if you're in your 30s and you're putting money into super, it's not until until you're 60 plus can you start taking it out. So the question then goes back to, yes, it's a better tax structure because you're paying 0 to 15% tax, but do I want that money to be locked away? Now, everyone here will have a different strategy when it comes to wealth creation. And for my strategy, the way that I look at it is Jenny and I, we max out our concessional contributions every single year. So that's around that $25,000 each, and we max them out every single year. And that's our strategy to build up that super fund while we're at our age bracket. But if you're, between 50 and 60, your strategy may be to max out the concessional contributions and max out your non-concessional contributions. And that may involve moving money from an investment trust into a self-managed super fund where you have that lower tax, where you have those lower tax rates. And likewise, the self-managed super fund is a separate legal entity, whereas your individual tax, personal taxes, are then looked at differently. So under your personal tax return, you can see here we have the marginal tax rates. And as we go through these brackets, we start increasing the percentage of tax that we're paying on every dollar above the brackets. Plus, we've got this lovely Medicare levy, which pays for Medicare. So with this in mind, when we're looking at the structure, we've got to make a decision between, do we put our investments under our personal name, where we're going to be playing this realm of tax rates? Do we put it in a company where we're going to be playing in 30% tax rate, but we get no discount? And this discount is actually, could be up to 50% of the total gain. Or do we put it under the trust where we have that complete flexibility of each year making that decision? So the example that I have here today would be, let's say you buy an investment property and that investment property makes $100,000 in rental income a year. And you've got your loan interest of 30 grand, you've got other expenses of 10 grand, and you're left with $69,000 worth of profit. And if we were to look at this and go, well, maybe we might want to push every adult up to $120,000 taxable income by using a trust distribution. So we make everyone here up to $120,000. And then what we might do is we might bucket the rest of the profit, whatever that extra profit would be, into the company. And that might be the best structure in the short term. Every single year until you sell the property might be the best structure to do so. So one of the fun activities, and it is fun, as always, these will be your fun activities, will be to think about how much wealth creation you're going to be doing, and then where do you want to be doing it under. And like I have here, the trust for me gives the most amount of flexibility to make those decisions. And a trust also allows for unborn children to be automatically included when they are born into it. But again, they're not really effective until they're over the age of 18. If you get married, have a second partner, their children, all that type of stuff are automatically included in it if they're by marriage and blood. So the question is, what is the best structure for investments? So anyone who's played this game before, anyone want to shout out or type in the box below of why they think a certain structure is the best structure? Also, everyone may be on mute. So if you're on mute, unmute yourself. Okay, that's fine. So what I'm thinking is the best structure here would be, or could be, every single time we buy an investment property, we put that property under a trust. So in 10 years time, 20 years time, we sell it. We have that flexibility to distribute the profits to mum, dad, grandpa, grandma, children, it doesn't matter, but we have the discretion to distribute those profits accordingly. So that's the first part. So then the second part is, if I'm doing share investments and I've got under 200,000, I'm probably going to stick to it being under my personal name. And the reason for that is just a cost of compliance and just thinking about things in a cost-effective manner. But if I'm going to build those shares up to above 200,000 in a relatively quick time, or I'm going to start off with 200,000, then I'm going to probably look at those ones under a trust as well. And with a self-managed super fund, for me, I always think about the balance has to be over $200,000 from a compliance perspective to set one up. So I'm not going to set one up prior to that, mostly because here again, all these structures that we do all have a compliance cost. And that compliance cost or that admin cost, we want to look at that and go, are you willing to invest $1,000 per year to save money on your, income tax? And is it going to be worth it in the long run? So that's why we want to look at these types of numbers. But we do have, as I said before, we do have a special activity. It's designed to help you guys work out what is the best structure for you. And this will be coming out next week. So obviously everyone here will be on a waiting list, and that waiting list will get emailed out accordingly. One other thing that I do like, that we touched on last week about that investment property side of things is remembering my definition. So the Hatchaway definition of an investment property is one that is bought for the sole purpose of making capital gains, and that property will cover all of its expenses, including the loan repayments, which is really important in a time like this. So if you're thinking of that investment property being something that's a negatively geared property, like an apartment in the city, then that means that structure, being the trust, might not be the right structure. So in my definition, investment property would be cash flow positive. The best structure could be the investment trust, and the activity that I sent out to you guys will help you go through that. And it's a really fun and engaging way to look at it. I just really feel like giving out homework, to be honest. I used to hate homework when I was in high school, and I feel like you all deserve some homework. I missed some. I missed some.
Thanks, Gary.
Thanks. Yeah. I know you need the homework, Heath. I missed some comments there. So Wayne, so going back to that, just so I can make sure I clear off on that question. Again, I'm just thinking from a compliance perspective of how much it will cost to run a trust. And if you have a balance over 200,000, at least then the compliance cost of $1,000 per year, divide that by your $200,000 worth of assets. means that you're paying an asset, admin cost on your asset value of less than 0.5%. So it feels good for me. I don't want anyone to be overcomplicated in their structures so that, the accountant gets, paid too much money. I think it's got to be fair and reasonable for the risk profiles. So now that we've gone through the structure, so the perfect structure for investment, so we've got a bit of an idea for that. The fun bit is how much we spend on lifestyle. Now, I've talked about how much money I spend on lifestyle and, clothes, cars, all that type of stuff. And I'm an open book on what I spend. But what I want you to be thinking about here is how much money do you spend? And, are you spending 100% of your income? So obviously I don't want anyone to, say if they are or anything that's, private on that nature. But I want you to be thinking about how much money do you make per year? How much money do you invest per year? And how much wealth do you want to create? Because if we're not investing in either ourselves or in assets that are going to generate wealth, then we're probably not going to become financially free. And if that's our goal, is to become financially free, every single person I ever speak to says that they want to become financially free, but most people don't have a strategy in place. And this is why we want to talk about how much money we're spending on lifestyle to make sure we have enough money left over to do the investments. Unless you're planning to win the lotto. And I'm sure one person wins it a week, maybe two people. But I think like 20 million tickets are sold. So it's pretty low chances. But if you are planning to win the lotto, quickly check if any family members are in here. No family members are in here. Like some of my family members, their wealth creation strategy is all about winning that lotto. I think it's silly, but that's what they've spent 40 years trying, and I don't think they're going to stop now. So if we go through this and we think why we condition the way we are to spend majority of our money on lifestyle, and I think about the game Sims. So I haven't played Sims in like 10 years, but I looked this stat up and 400 million people play Sims a year, which blows my mind. Like I just don't get it, how there could be that many people playing it. If you want to raise your hand if you've ever played this game before, or maybe a little bit too embarrassed to raise your hand. Couldn't just be me. If it's just me, that's awkward. So nice. At least one person is being honest. Maybe two people. Dave, yep, good. Could just be our generation, actually. I don't know. But I was thinking about this and going, I like to gamify making money. I like to gamify lifestyle, and I like to reward myself. And I was thinking, the first house I bought was to live in. The first house I bought was a 2-bedroom, 2-bathroom townhouse. And then, you do a little bit better in life and make more money. And then the second house I bought was the apartment that we currently live in. And I was like, all I've done is I've gone from spending a certain amount of money on lifestyle, and all I've done is just doubled or tripled that amount of money to be able to buy the apartment and to live in this apartment. And I'm like, I know why I did it, but I'm like, why am I conditioned this way? And why is everyone conditioned this way? And this game perfectly sums it up. So for me, this game teaches you how to, you acquire assets in a house, you do some form of education and promotion in your job, you get more assets, you build the house and you expand on that house. But it doesn't teach you to take that money, buy investments, buy businesses, or do other things. It just teaches you to consume. And that's probably why the US economy is so freaking strong from a consumer perspective. And it's phenomenal because people just consume so much shit. So they're not investing in the future. So that's what I noticed with Sims. I haven't played Sims 4. I think that's the newest one out. I haven't played that one, so maybe they're incorporating some wealth creation strategies in there. I'm not too sure. But what I've noticed is that most people go from upgrading their car, upgrading their house, upgrading their lifestyle, but they don't upgrade their wealth creation. And that is what we're here to talk about today. So if you are terrible at budgets, if you think budgeting is too hard, if you go, I don't want to do spreadsheets and all of that, then this system becomes quite simple. So we can do this for the business, or we can do this for personal, but this one I've just done for the personal side of things. I think this is where most people are falling over. And the same concept works for the business. So if you just imagine all of these categories, right? All these different categories are buckets of money. And you think about, well, how much money should I be putting into each of these buckets each week? And say we broke it down into something like this, where you put in, $300 a week into food and bills, $200 a week into personal spending, that could be clothes, going out, partying, whatever you want to do, $100 a week into other, your car, insurance, petrol, all that might cost $200 a week. The house may cost you $300 a week for rent, or you're contributing to the mortgage. Obviously, everyone should have a holiday each year, so you might want to put away, $5,000, $10,000 a year, so $100 a week for a holiday. And then you've got to have, for me, the most important part, the wealth creation side. I've purposely left the tax out here because it becomes really hard to give an example of what the tax would be for everyone, because each person is separate. But again, you would have your tax one here, and this would be your Pacific number. So each week you could have all your income come into this income bank account, and let's just say it's $2,000. And whether you say that is wages, because some people here will be getting paid a wage, some people getting a dividend, and some people will be getting a trust distribution. Doesn't matter which method you take the money out of the business or you get paid as an employee, it's irrelevant. But $2,000 goes into your personal banking, and then it could get split up all this way. So if you were to split it up this way, the question then goes to, say, this bank account. Say you set this up as a transactional bank account. So it has transactions. And what happens at the end of the week or tonight? So what happens when you go, shit, I have not bought flowers for my lovely wife. I better buy flowers, and maybe they're really expensive because it is Valentine's Day. So maybe it's really expensive. And maybe I end up spending more than my budgeted amount on, maybe I spend more than my budgeted amount. But each week I'm going to be able to see, because these accounts or these categories would have less money in them. So if you set up different transaction accounts for these different categories and you run out of money, that means without even having a real budget in place, you can see that you're taking the money from somewhere you shouldn't be. When I finished high school and I moved to Melbourne, I think I had around $2,000 to my name. So, the first thing I did was walk down the street, and I was wearing a suit, and it was summer, and I was getting really sweaty. And I walked past the first nightclub or pub venue, and it was under renovations. So I walked in there, gave them my resume, and I said, looking for work. And they said, we're under renovations. We'll give you a call later when they stop in like 3 or 6 months. And then I walked down the street even further, things like 500 meters or something, or a kilometer, got to the next venue, gave my resume, got a job for that Saturday night. So I worked out pretty quickly that I need to be really careful with my money, because I only had $2,000 to my name. I had a couple months before uni started. I needed to pay my rent, my food, my car, all that type of stuff. And I was really intelligent, and I bought a car, and we're going to talk about that a little bit later, of what I did with the car. But I needed to budget, and I didn't want to do an actual budget. So what I did was I worked out, and I did not get paid $2,000 a week. It's more like $500 or $600 a week 10 years ago. But I worked out what my categories were for each of these ones. I think I spent about $75 in food a week. And what I found was, when I wanted to be silly and I would, want to go out and spend more money than I had to spend, I would take it from one of these accounts. But I knew I had to put it back in by next pay cycle, or otherwise I'm going to have a shortfall at some point. So I would never take money from my house account, because I've got to pay rent, right? And if I didn't pay rent, I'm going to get kicked out. So going out and partying, going to the movies, going to a nice restaurant, whatever it may be, is less important to me than paying my rent, because I need a place to live. But this method allowed me to budget my money without having a budget, without actually putting too much effort in. And as I said, the same principle applies to the business, and you can break up your business accounts in a similar manner. So I did this for about 10 years. Now I really only have two accounts. I have an offset account and I have my personal spending one, but I'm at a different place now where I'm a little bit better with my money and I have systems in place to allow me to not make the mistakes that I used to make. So the fun activity that we have, obviously getting sent out next week, is a method for you guys all to work out how much money you would put in these accounts. And then you can, if you want to, you could set up the bank accounts and you can follow this system. The biggest part about this system is that you want it to be automatic. So once you set this up once, I want automatically each week for these transactions to happen, because I don't want to think about it again, because I'm quite lazy when it comes to that. I want, Monday to be the money to get paid into my bank account. On Wednesday, these automatic transactions go on, and then I spend the money by the following Monday again. So you want it to all happen automatically, so I don't have to think about it. And most important would be this one here, is the wealth creation. If you're not paying yourself, per week for wealth creation, then you can't complain at the end of the year when you haven't done anything, right? So if you're not putting money away to buy shares, buy property, buy gold, I'm not an advocate for cryptocurrency, but whatever your investment may be, if you're not planning to do it on a week-by-week basis, month by month, even when the times are shit, even when your business is going terribly, my wealth creation is one of the first bills that gets paid. My money that goes into my share account happens every quarter. I think the number will be around 20, probably 30K or something this quarter. But that's my first bill that gets paid, irrelevant of how the business goes, irrelevant of what I spend my money on. That wealth creation activity is going to happen because I have a plan and I have a strategy and I want to achieve the wealth that I want to achieve, and I have to do it. So for me, this happens first and everything else happens second. But that's the way that I'm wired. So the activity will get sent out for everyone, and you can play around with this. Thanks for drawing on the screen, Heath. You can play around with this.
I was just going to write something under car for you.
Under car, the Maserati. Speaking of cars, has anyone made an interesting car purchase that they regretted or thought that maybe that wasn't the best decision to be making with their money? Yep, a couple of people have put up their hands. Thanks, Steve, for joining. I did when I was, I did it when I was 18. 19. My mum bought me my first car for $7,000, and there was nothing wrong with that car. But as a 19-year-old, I thought it was a great idea to sell that 1998 BMW to buy a 2006 one and get myself into debt. And it was a personal loan as well. So the debt was like 15 or 16% interest while I was going to university, working part-time, enjoying all of that. So I made some dumb decisions there, learned some lessons along the way. But I think cars are one of the biggest traps for wasting money. And when I look at this, and depends on what industry you're in, but Johnson, my brother-in-law, he just walked past, so I'll use him as an example. He doesn't have what I like to call an accountant's car. He has something else. I think an accountant's car is a European one, BMW, Audi, Mercedes or something, and he has not one of those. So I always make fun of him that he doesn't have an accountant's car, but he is being sensible with his money, where I'd be a little bit less sensible in that setting. So what happens when you steal the money from those different categories? So if you've got, your house, say your house cost is $3,500 per month, and you're putting your money away each week, and it comes time to pay your mortgage, and you've only got, $500 in there because you've spent too much money on your holidaying or whatever may happen, you're not going to be able to pay those bills. So the first thing to a good solid budget is being realistic with how much money you spend in these different categories. And the second thing is trying to commit to being consistent with that spending and those spending habits. So great that you've had no regrets ever on any car purchases. I'm sure there might be one or two there. So I guess, if you keep going down that path of stealing money from one jar to the other jar, and if we just think about the tax bucket, so most people here will be putting money away for income taxes, and shit goes wrong in business or in personal life, and you take some out, right? I've done it. Sure, most people have. It is what it is. But the problem is when we keep doing it, right? So it's okay if it happens once. It's a bit of a cash flow problem. We fix that up because we know XYZ is going to come in later. But it's when we keep doing it. So the example that I have at the moment is my steel business. In my wisdom, I obviously set up a steel business, invested a couple $100,000 into that. And in October, I had November all scheduled out. Fantastic. My camera's gone off because my battery's run out. So let me quickly change that. And that must be how long that lasts for. So in my steel business in October, I had October, November, I had December all worked out. I had that all scheduled up, and I had January scheduled up. And I'm like, this is awesome. I'm gonna make tons of money. This is the best decision I've ever made. Running a business is easy. I'm awesome. And when December came around, all the jobs that we had planned all got pushed out to January. And I was like, okay, that happens. Oh, trade is a bit shit, actually. Trade businesses suck. Why can't people stick to freaking schedules? How hard is it? Anyway, so the question then comes back to cash flow. So in this case, I had enough cash flow to my own other money to push into that business to get it through the period that I needed to get it through. But the problem would be is what if I didn't? So if I was running that business and I didn't have an extra 50K cash to front that business over December and January, I'd be in a lot of trouble and I'd be taking money from elsewhere. So if it didn't recover by January, because all the jobs got pushed from December to January, I'm like, oh shit, that's just one bad month. It can't be two, it's just 1 month. And then again, the building industry is a great industry. Everyone goes away, stops working, comes back. I swear they don't want to do any work in January, and nothing happens in January. I'm sure Scott knows all about that one. January is pretty much a write-off. So because of that, I blew up my cash again for a second month. And then I started going, shit, do I need to take money from a bucket that I shouldn't be touching? And in this case, again, I managed to get through. We're back to being on schedule. February is going to be a great month. March is going to be a great month, and we're back to where we should be per month. But if you're taking money away, you're going to lose the ability to invest that money or invest it properly. And you may end up finding yourself that you keep treading water and taking money from one account, putting it in another account, and you're never getting ahead. So we just want to be really careful that we're just not treading and just going around in the motions, stealing money from here, putting it here, stealing money from here and putting it here. So the question goes back to how much money should you spend on lifestyle? And that all depends on how much wealth you want to create. So for me, creating wealth, becoming financially free is really high on my priorities, more higher than me buying a red Ferrari. So instead of buying that Ferrari that I wanted to buy, I invested $400,000 into a steel business. And like I said last week, that steel business will have the ability to buy me an investment property every single year for as long as I have it. That's a better use of the money than buying the car. So if we look here and we go back to this bit here, it depends on how much you prioritize the wealth creation. So this activity will help you to determine that, but you need to be aware of, if you want to spend more money on lifestyle, you're going to spend less money on wealth creation, unless we start being a little bit more smart about it and we go, well, how about I need 100 grand to live on? So that's the number. I need 100 grand for lifestyle to live on per year. How about if I make more money in the business, or I get paid a bonus, or I have a really good windfall? How about I put that money, extra money, into the investments? How about each year I just live off $100,000, and if I get pay increases, business makes more money, whatever it may be, how about I put the rest of that into investments, right? Instead of increasing the lifestyle. So we go back to here in this example here, instead of going say I start transferring $2,500 a week into my personal bank account. Again, good size amount of money. Instead of reevaluating all these numbers, right? How about I just do this one? And how about I just put that extra $500 a week into here and imagine the wealth creation over a 5-year period, investing another 25 grand a year into wealth creation, accumulate that over 10 years, that's going to be a lot of wealth. And that's what I would look at. So this activity will help you to define that. And that's what I want people to be thinking about here is just because we make more money in business doesn't necessarily mean we need to spend more money on lifestyle. And that could mean that we can do more wealth creation activities. Now, the leveraging part. So everyone here, I'm sure, has a loan or has had a loan in the past, right? Leveraging means we can borrow money, but there's no point in trying to borrow money if we're already in a shit financial position. So what happens if we have debt? Do we have good debt and do we have bad debt? Now, the debt that I talked about before with the 2006 BMW that I purchased, I would consider that as bad debt. One, because it was a personal loan at like 15-16% interest rate. And two, I didn't need that car. Like, honestly, I could have still drove around in that 1998 BMW. I drove around a 2006 one because it was cooler. I'm sure it helped me with my, thinking the delicate way to say this, I'm sure it helped me with my extracurricular activities outside of work. But the reality was it didn't help me make more money. I didn't generate any extra income because I had that car. All I needed to do was get from A to B in a respectable car for the cheapest amount of money possible. So I could have had a Toyota, a Honda, I don't know, Holden Ford or something more reasonable. I didn't need to have that type of car. So debt here then becomes an interesting one between good debt and bad debt. But what happens if we're already in a shit position? And this happens to a lot of people. Hopefully not many people that are watching this has happened to, but let's say it has. And the same principle here applies to business debt and also personal debt. Doesn't matter what it is, doesn't matter how much numbers are, doesn't matter that these might not apply to you directly, but it could, the principles still will. So let's say you got a $10,000 credit card. Most people here have, I would assume, has a $10,000 credit card. I definitely do. I opened up Jenny's purse the other day to get her something, and I swear I saw like 10 credit cards, and I was like, why do you even need so many? But people like the credit cards. Again, some people might have personal loans. Sometimes we use them strategically to do different things, but let's just say you use a personal loan to buy a car like I did because that was silly. Some people might have help debt, or that's debt that you've accumulated from going to university and you haven't paid it back yet. Fun fact, I looked this one up, not so much fun. It's currently, because of inflation, going up by 7.19%. How crazy is that? Everyone thought HECS debt was like a 2-3% increase. Right now it's 7%. I don't have HECS debt, I paid it off, but it's crazy that it's going up by that much. So those that have HECS debt right now are going to be in a rude awakening in 3-6 months time when they realize it's gone up by so much. And let's say you have Afterpay. So the fun game here is, if we want to type in the chat box, if I open the chat box back up, if we type in the chat box, what do you think you should pay off first? If you've got some extra cash and you go, okay, Gary said that we should be getting rid of this bad debt, and let's say all this is bad debt, which one's the first one that we should be paying off? Type it in to the chat box. Just 1, 2, 3, or 4. 4, Heath, Afterpay, yep. Credit card. Yeah, I think that Afterpay, credit card, help debt is obviously only paid when you lodge tax returns or comes out of your wages. Personal loan, Yep. For, again, Afterpay. Now, this is the trickiest part of our financial literacy. So the decision has to be made is what is the best use of your money? So if we go back to this page, before I drew all over it, and we just said this other, which is $100, let's say we had $100 to allocate to one of those debts. Now, I'm a sucker here for getting some endorphins and feeling like I've achieved something. So the first thing that I would normally want to pay off here and then stop using it, because that's also part of it, would be Afterpay, because it's the least amount of money. So I'm looking for an easy win, something to keep me motivated, something that I can say, boom, I've done the first thing. I'm going to stick to what Gary says. I've ticked off one box off. This is great. So the first thing that I would target would be the Afterpay. Afterpay, generally speaking, would only have late penalties, but no interest. So from an interest perspective, you're probably not better off. But from the fact that I've now got, because they're normally paid over 4 or 6 weeks out of your wages, so that might be $500 a week that was all going to get direct debited out. But I'm going to roll that money on and go, well, if that $500 a week wasn't part of my budget, so that didn't exist in here, but I went out and bought a new TV or something anyway, then I'm probably stealing money from a different bucket. So let's just say that $100 a week, I'm going to roll that one into the next thing. And the next thing I've got to decide is, one, I'm going to stop doing Afterpay. So once I pay that off, I'm closing it down. I'm never thinking about it again. It's not in my vocabulary to be able to buy something that I can't afford. And if you can't pay for it in one payment right now today, then you can't afford it. And unless your house is leaking and you're going to get someone to come fix it and they can Afterpay it for you or something, then we're not going to be buying it. So first thing I do would be pay off Afterpay, cross it off. And then it gets difficult. So credit cards at 18%, which is higher than 15%. So straight away, this is the highest one that's costing me an interest. So this is the best return on investment by paying it down. The second part is, this is 10 grand. And if we only have $100 per week, then that means that it's going to take us 2 years to pay this down, right? And that's if we don't spend any more money on it. Likewise with the personal loan, that would take us 3 years. But the point here is that I've got my easy win. Now I've got to suck it up and do the hard yards. If I put myself in this position where I've borrowed money to spend on a credit card, I've heard of examples where people have paid off their credit card. They've got it down to zero. How amazing is that? Then they go to Europe and max it out again. Let's not do that. Let's take the credit card. It's at 18%. That's the number 2 one that I would pay off. And once that's paid off, I would cut it up. Whether you cut it up before you pay it off, that may be a better strategy so you don't keep adding on to it. But again, I want to take it out of my vocabulary of being able to use it. So I'd roll the $100 a week into here. But because this one's, we're paying minimum payments of minimum $250, it means that I can roll the $100 a week into this loan plus the minimum repayment that I used to be paying into here as well. And I can let that compounding effect happen. So it might take me 2 years to pay off the credit card, but because I'm already making loan repayments, and if we go back to here, my loan repayments may be coming out of my car account, and say that is, $800 a month, I might already be paying $800 a month. I roll that into here. I've got extra $100 a week. So that takes us up to $1,200. I've now got my $250. So I'm now doing $1,400 a month in payments to this personal loan, which means, give or take, this will be done in 11 or 12 months, depending on the interest side of things. So the first is the easy win. The second is a little bit harder because it's going to take a while. But the third, we start getting onto a roll. And once those 3 are paid off, the real question then goes back to, do I have a house? Do I have an investment property? Will me paying off my help debt help me service those loans to be able to buy more property? Or is it charging me so much money in interest, 7.19% now, that it's a good investment to pay it down? But I've got to make a decision between, do I have a family home, which is more important than paying off help debt? Do I have an investment property, or can I get an investment property? And maybe the answer is no, because this is affecting your serviceability too much. So we want to look at those. And this is where financial literacy comes into it, because we first targeted the one that's a really quick, easy win to keep everyone motivated. Second, we targeted the 18% interest rate, because that's the highest amount of return on investment we're going to get. 18% is crazy if we were to earn that in the stock market or something. So let's pay down that interest that is that high. Then we target the one that's 15%, because this is quite high as well. This is 150% higher than the average return in the stock market. So our money is better spent paying down this loan than investing in the stock market, because we're going to get a better return on our money as long as we don't continue the debt cycle. And then obviously the fourth one would be the help debt. If you run a business and you have help debt, you might make a decision to pay that off over a 3 or 5 year period, but that's depending on your structure. You may be a little bit more flexible in how you pay that off. I know for me, I decided not to pay mine off until my best friend paid off his. And then once he paid off his, I decided to pay mine off in a lump sum payment. So I kind of pegged my income always at a level that allowed me not to pay it off. And then once he paid off his, I just transferred 30-something thousand, paid it off the next day. So that's how I did my one, but each person can make a decision. But that allowed me then to save that 30K, invest that into property instead and into the stock market. And that was when interest, or the CPI calculation, was a lot lower than 7%. So now we've got rid of the bad debt. So whether that's business bad debt or personal bad debt, we've cleared up all that bad debt. So now the question is, how much money can you take from your income to invest in residential property? How much money you could do in commercial properties, and how you could actually do this from a leverage perspective. So we've got a couple of different topics over the next few months that we'll be talking about scaling a business. Next month, we're talking about wealth creation. So we're going to go heavily into property, heavily into the stock market. And generally speaking, these parameters here on a residential property, the bank will allow you to spend 30% of your wage, or 30% of your wage will be allocated on your house. So if you want to get a house that's going to involve a $10,000 a month mortgage, that can only be 30% of your income. That's how they do their calculations. If you're thinking about buying an investment property as residential, then you'll have to put down a 20% deposit plus costs. Commercial property would be 35% plus costs. And they normally have these covenants on interest. So what that means is you might have interest expense for that investment property of $50,000, but they would require you to have income of 1.75% of that interest expense. So for example, $80,000 in revenue. So sometimes the deposits the banks require you to have don't even match their banking covenant on interest. So they kind of screw you there a little bit too. So you got to be careful there. There's not always a straight 35% deposit will get you in. And the biggest one is this 15%. So my factory that I have is over 15 years, not 30 years. Residential property, normally 30 years. Factories, commercial properties, normally a lot sooner. So it kind of stuffs with the cash flow a bit. So you have to decide then that extra cash flow. I was expecting to pay $5,000 a month in my mortgage for my factory. And by the time it all happened, I'm paying $10,000, which is a huge detriment to my cash flow. However, I then look at that I'm going to pay it off quicker. I'm going to take the profits from that steel business. I'm going to put it into paying this loan down faster. I may refinance or something later, but I'm still going to work through that one. Business loans, buying businesses, buying into franchises, doing investments, generally speaking, you get away with a 30% deposit. And we'll be talking about that when we're going through systemizing and scaling a business, which is later on. And generally speaking, they're 2 to 7 years. So most people get caught out here is if we have a business that is, maybe making $100,000 profit per year, but the loan repayments are going to be $100,000 a year, you may not get any physical cash from that investment until you've paid off your bank loan. And that might take you 3 or 4 years. So you might decide not to do that type of business, or you might decide to start it from scratch. The reason why I went into the steel business, which some of you will know, is I went to buy a steel business, but the multiple that they wanted was 3 times profit. So they wanted $2.1 million on a $700,000 profitable business. And after a while, they didn't have systems, they didn't have processes. I felt like they were kind of fluking it a little bit. And I'm like, it's not worth 3 times that amount. So instead of me buying that business, getting a loan and buying it, I just decided that it was in my best interest to start that business up. We're now in for 300-400 grand cash. We're into that business buy. We're not making $700,000 yet, but maybe next year, the following year, we can get up to that point. And then we'll determine if I made the right decision between starting the business brand new and investing the money, or if I should have bought it. But I know that I have 3 years to get up to $700,000 profit before I would have recovered my return on investment, my original capital. So when I look at that, I'm not so upset. I know I've got 3 years to grow this business into where I want it to be before I'm behind the 8 ball. And sometimes in business, we want to grow and we want to take our revenue from $100,000 to $200,000. And that normally requires additional working capital. So sometimes it's really smart to be getting a business loan to handle that working capital growth. And generally speaking, we're talking right now, because of interest rates and where they're at, we're talking around that 10% interest rate part. So again, we can use banks to leverage. We want to be using them to be buying residential properties, commercial properties, investments, buying businesses, expanding our business. We want to be using them for all of that. But what do banks want? And if you're not doing your accounting stuff legitimately, if you're not paying the right amount of taxes, you can never borrow money. If you're not on paper making $1 million, then you're not able to borrow, $10 million. If you're not on paper making 150 grand, you're not able to buy, not able to buy $1 million house. So on paper, you have to be making the money and you have to have a good credit history. So what I implore everyone here to do, and I will send this out with my one of my fun activities, was I use a credit scoring company that's free, and I check my credit score every single month. It's kind of stuck around 884 out of 1,000, which kind of annoys me because I want to be 1,000. I don't know how to get there because I've got a perfect credit history for like 10 years and it's still not at 1,000. So I haven't worked out that yet, but I am in the top percentile. And what I implore everyone to do, at least be monitoring what's on their credit report, what that number is, because this is what the banks are looking at. So if you have a good credit score, which is above 550, so 550 out of 1,000, above that's good. Average is between 500 and 600, and below 500 is considered bad. And that's when we want to look at, okay, why are you getting those bad scores? Do you have credit cards that you haven't paid off? Do you have a Telstra bill that hasn't been paid off in 8 years because you hate them and you never want to talk to them again, but they've screwed up your credit report? So you got to look at that, because this is exactly what banks look at. And sometimes you go pretty far down a bank loan and then you realize that you have a bad credit score and the bank turns around and goes, nah, not dealing with you. And that's frustrating for all accounts. So you want to know and have an understanding of what that is now. So when you go down the path of borrowing money, you're able to do so without too many problems. The lending dilemma. So everyone in here would know that we have a dilemma between having as much taxable income as possible and paying the least amount of tax. So the banks love taxable income. The ATO loves it even more because they get more money out of you. We, us, the people, we hate it because we have to pay the money and we don't like paying money. Nothing worse than me paying tax bills, and nothing worse than when I have to tell you guys to pay tax bills. It sucks. So the question is, how do you make sure that your income is the level it needs to be to buy the properties that you want to buy or do the investments that you want to do and pay the least amount of tax as possible? So you need to strategize a little bit. So if we go back to thinking about this year, so this financial year right now, so we're in 2023 financial year. If we're borrowing money from the banks, they're going to ask for 2022 financials and tax returns. So if those tax returns are really good, they're going to give us the money. If they're really bad because we put all the money, we did cash jobs only, and we have no profit whatsoever, they're never going to give us any money. And that hinders your ability to borrow money, and gives us, doesn't allow us to build that wealth or do that wealth creation side of things. So what we want to do is have a balancing act between being too aggressive on tax deductions or cash income, having enough taxable income to get you the loans. And I always start out now, like right now, being, February, March, April of a financial year, to strategize how much money needs to go into Gary Brown's personal name to satisfy the lending for the bank. So what properties am I buying next year? That will satisfy that. So as we've had a child recently, we know that we can only have $120,000 per person, me and Jenny, in our personal names to make sure that we get the best rebate possible. And the rest of the money would go into other people's names, like my parents, someone else's name, by doing trust distributions. So from a lending perspective, I know that the banks are going to hate me because they're going to go, Gary, you only earned 120 grand a year. How can you borrow more money? But the reality is I have a business. The business makes X amount of money. The money sometimes finds its way into other people's bank accounts, like my parents. Trust distributions, perfectly legal. But I've got to weigh up how much money do I pay in tax personally, which allows me to borrow money, which then allows me to grow my wealth, and minimizing my tax as much as possible. So the question is, and I'm sure everyone can answer in the chat below, would you prefer to save $25,000 a year on tax and pay no income? Or would you prefer to pay the tax and have $25,000 a year for lifestyle and investing? So jump away. Which one would you prefer? Option 1 or option 2? That was on it. Number 2. Anyone else? Anyone think number 1? Probably less likely to think number 1 if you're in here, but there's a lot of people out there that will be picking number 1. And a lot of people will do it for their whole lives too. They'll do number 1 for the whole lives, never pay income tax, never contribute to the government. In that setting, they probably never have superannuation either. They don't get to buy any investment properties. They probably have the house that they live in, and that might be really nice because they put that cash income into renovations, but that might be it. So in this case, I prefer number 2 too, because that gives me the leverage or the lending opportunities. And number 1 is just you're in the current world that we live in with data matching, you could be in a lot of trouble if you try to do number 1, which obviously we wouldn't recommend. But so the first property that I bought was 2017, $305,000 plus stamp duties and that type of stuff. So I think it was really about 320. I took out a loan for $285,000. I was earning taxable income around that's $65,000 on at that point in time. And that allowed me to buy the house because this income allowed me to get that type of loan, which I also sold it for sometime last year for $685,000. So if we use that example of paying the tax on $65,000 would be probably $12,000 worth of tax. Say, for example, I did that just for 1 year only. I paid 12 grand in tax. I used 30 grand cash. I turned that into, just under $400,000 cash. That's the best 12 grand you're ever going to spend ever in tax, right? So spending that money in tax allowed me to buy the asset. Buying that asset has allowed me to start the steel company. This cash goes into my steel business, and hopefully in 12 months' time, I'm saying that this cash then goes into investment. That's an I. For everyone that thinks that's not an I, that's definitely an I. Hopefully that goes into investment properties every year after. So it's that compounding effect. So just running on time, it seems. What's next? Over the next couple of weeks, we'll be sending out the activities. This will be on record if you want to watch any different parts of it. The next webinar that we will be doing will be on Wednesday, the 8th of March at 7 p.m. It's going to be all about wealth creation. So I will do a special webinar, but we will be having guest speakers. So Madison Rogers from Morgans, he's going to be talking about index funds, LICs, growth portfolios, managed portfolios, and capital notes. Then the following week, we're going to have one of my good friends, Anthony Sewell. He's going to be talking about property, investment properties, and we will be having Andrew Barnett on talking about shares and share education. So next month is all focused around wealth creation, which is so exciting. I tried not to touch on it too much on the last 2 weeks because I'm so excited for next month of what I can share with you all and the different guest speakers and experts that we have coming in. So this month was more about me talking on these 2 topics, but next month we have some amazing people that is going to be really exciting to have on. Likewise, again, for the people that have not seen, so the Hatch Away, it's a program that we're designing at the moment that is to impart the different learnings that I have had over the past 10, 11 years of being an accountant, going through this wealth creation journey, and trying to impart that onto you guys and everyone else in the wider community. So we will be having experts on that. We will be having 10 different special topics, and we look forward to being able to share those topics with everyone over the coming months.